Greetings, this is going to be our monthly inflation update, and a lot is happening in the stock market, but nonetheless I'm going to blast through this pretty quickly in order to minimize the amount of repetition from one month's video to the next. Now those of you who are familiar with this channel know that I consider inflation to be not nearly the evil that it's made out to be, because inflation in fact is a fuel of technological progress, where the deflation is far more destructive, which is something you can learn about in this video up here. And the optimal amount of inflation, which I've described elsewhere on this channel, is for all three of these key metrics to be at 3% at the same time. So the US Consumer Price Index 10-year compounded annual growth rate, the Goldman Sachs Commodity Index 10-year compounded annual growth rate, and the 10-year US Treasury bond yield. Now, actually, this is a very low metric, because for the yield curve to have a normal spread and the Fed funds rate to be even 1%, the 10-year US Treasury should be around 4%, but the symmetry of 333 is pretty good. So this is the easiest metric to meet in this age of technological deflation. So let's look at each of these three metrics in the manner that we do each month. First, the US CPI. So we go to the US Bureau of Labor Statistics website and we click on this little graph image over here. Now in looking at the CPI, we take the most recent number and the one 10 years ago. So we take 288 divided by 229, 288 divided by 229. That is 1.257, so about 26% inflation in the last 10 years. So what does that come to in terms of a 10-year compounded annual growth rate? For that, we take the 1/10th root of this. I hope everyone understands the arithmetic here. 1.023, so 2.3% has been the annual CPI inflation growth rate, 2.3%. So this is rising a little bit from earlier months. However, it's still a long way to go from 3%. And as we know, the recent inflation spike is only for one reason, which is that the oil and natural gas production in the United States domestically has been halted by the Biden administration for reasons that are very questionable. And it's not a partisan thing. Republicans have been on board with that as well. And that is causing inflation, which has caused an oil and natural gas exporting power, like Russia, to be more powerful than it was before, and to entertain an invasion that it wanted to do for a lot of years, but was not powerful enough to do before then, which makes oil and natural gas prices higher still. Of course, this attracts more technology to create more adaptations around oil and natural gas prices being high, such as demand destruction as well as supply increase, through more discovery, through alternative technologies, and some people not consuming gasoline altogether, more people working from home. $6 a gallon of gasoline is in fact a good excuse for work from home practices to continue. Now, speaking of oil and natural gas, we go to the Goldman Sachs Commodity Index. This is the Goldman Sachs Commodity Index, and by clicking on the 10-year number over here, you see the 10-year compounded annual growth rate. And that's 1.15%. So it's still nowhere near 3%. And remember, oil and natural gas are rising in price, but gold is still not rising in price. Gold is in fact a terrible investment thesis, as is proven again and again, because even when other commodities are rising, oil and natural gas namely, gold is not rising. So why anyone would think gold is a good investment thesis is crazy. That whole community is infiltrated by people who like gold for ornamental reasons and who like gold jewelry, but are not actually tracking the returns. They don't even talk about the returns. And then the few people who think gold is an investment thesis are commingled with that group. So there's not a lot of intelligent output in terms of the pro-gold investment thesis that is occurring. So the Goldman Sachs Commodity Index is 1.15%. And now we go to the third metric, which is the US Treasury bond yield. 10-year US Treasury bond yield that you can see over here, 2.83%. So it's risen a lot. It was 0.5% in July of 2020 and now has risen all the way to 2.82%. So more than 5 times as much of a rise. That is extremely bearish for the stock market for there to be this steep of a rise. It's also extremely bearish for the housing market, because a lot of people purchased houses when mortgage rates were low, not realizing that home prices have swelled in proportion to those mortgage rates, and when mortgage rates go high, their home goes into negative equity. But as you can see here, this 3% threshold that I put forth in that inflation matrix is a level that is very rarely breached in the last 10 years. It was barely above 3% for extremely brief periods, and that always led to a correction back downwards because of stock market pressure. Now, if you go further back than 2012, yes, the 10-year yield was more than 3% for most of the 50 years prior to 2012, but that was a pre-technological age. That was not the atom era of exponential technological deflation. High tech was too small a portion of the economy to cause distortion of these traditional metrics, whereas now that is no longer the case. So yes, the 10-year Treasury yield has risen a lot, and of the three metrics in my inflation matrix, it will be the first to cross 3%. However, this chart doesn't lead us to believe that it can stay above 3% for very long. And remember, the Federal Reserve is tightening. That's why it's even rising at all. The Federal Reserve is selling treasuries, even though the US government is also selling treasuries. When bonds are sold by the two biggest entities that can sell them, the price of bonds goes down and the yield goes up, and that situation cannot exist for very, very long. So now we go back to my inflation matrix and see how all three of these metrics line up in the scorecard. So the inflation threshold of 3% 10-year compounded annual growth rate of US CPI, 3% compounded annual growth rate of the Goldman Sachs Commodity Index, and 3% 10-year US Treasury yield, all three at 3%, all three are 10-year type metrics. What are we now as of April 15th, 2022? As we saw, the CPI is at 2.3%. The Goldman Sachs Commodity Index is at 1.15%, and the 10-year US Treasury yield is at 2.83%. So this is the one that's the closest to reaching 3%. Goldman Sachs Commodity Index is the furthest away, but it could cross 3% because it's kind of volatile. But the US CPI takes a lot to move the 10-year compounded annual growth rate. And yes, the CPI is currently high for the reasons I mentioned, mainly oil and natural gas. But that can cause a stock market crash, which causes those things to fall as well. So it's still a long way to go before this gets to 3%. And remember, 3% is not an alarm zone. This is where we want it to be optimally, because that's when technological progress is the fastest. The only thing that would be negative about it being much more than 3% across all of these metrics is that the poorest people are in fact suffering a fair amount. So even though technological progress would be even faster, that would come at a certain human cost. So I say 3% is the optimal cruising speed for rapid technological progress on top of the minimum amount of human suffering, as well as people who own mortgage houses making home equity gains. For a lot of people, that's the only net worth that they have, and inflation is in fact what creates home equity gains. Very few understand that. They would rather pay $1 less per gallon in gasoline but miss out on $300,000 of home equity gains, which exceeds the amount of gasoline they're going to pay for in their whole life. And I'll talk about that in other videos as well. But 3% is a threshold that is optimal, not high. And again, this time we know the inflation is not because of Federal Reserve monetary creation. It's because of deliberate supply restrictions on oil and natural gas production. So the correct response, even if it goes above 3% in all three of these cases, is not to stop quantitative easing. It is to stop restricting oil and natural gas production. And I'll talk about that in other videos on this channel that will emerge in the coming days and weeks. But anyway, I hope you found this to be informative, and this type of content gives you a more holistic understanding of these all-important economic and financial metrics. Thank you very much for watching.